A very good morning, friends. I hope everybody is doing good. So, today we are going to start with another very important topic, and that is consolidation. Now, consolidation, as you know, is got a couple of standards. We've got Ind AS 103, business combination, Ind AS 110, consolidated financial statements, Ind AS 111, joint arrangements, Ind AS 28, that is accounting for associates as well as joint venture. So, a couple of standards. And we're going to spend almost like 3 sessions covering these consolidation standards with you. We're going to first of all start with Ind AS 103. So though what I've done, I've just taken around 20 questions with me, which is pertaining to a mixed blend of standards on business combination as well as on the consolidation standards, which I mentioned. Now we're going to start a journey on Ind AS 103, that is business combination. Now I think before I start off with the concept of business combination, I think let's take a little quick recap in terms of what is the thought process when you're doing Ind AS 103. Then I think we'll start with the practice of practical questions with you. The first thing what should come to the mind is that when you look at Ind AS 103 business combination, the first thing which you need to identify is that it should be a business. And number two, you need to get a control over the business. So there are certain tests which are given in the standard, which helps us to identify whether it is a business or not. The two tests which are given in Ind AS 103, the test number one, that is called concentration test. And we know the concentration test is an optional test. That means an entity is free to choose whether it wants to apply the optional concentration test or not. But just to remind you quickly, that when you apply the concentration test, if the entity chooses to apply the concentration test and you pass that particular test, we reach a conclusion it's not a business. And if you apply the optional concentration test and you fail the test, then there is a need to apply the IPO test, what you call the three-element test, or you can call the input process output test. And the third course of action is that if the entity decides, no, we are not applying the optional concentration test, then of course, again, it is to apply the IPO, the three-element test. So just keep three parameters in mind. Number one, you may choose to apply the optional concentration test or not. If you do not, then you apply the three-element test. If you say, yes, I'm applying it, and if you pass the test, then in that particular case, it's not a business. Then Ind AS 103 cannot apply. And if you apply that particular test and you fail the test, then you need to apply the three-element test. Now that is the initial inputs. Now, once you apply the test in terms of determination that whether it is a business or not, you fall in the scope of Ind AS 103. And once you fall in the scope of 103, then follows what we call acquisition accounting. Unless it is a case of, you can say, reverse acquisition, or it is a case of what we call a common control transaction. So we'll be doing questions on the reverse acquisition separately. We'll be doing questions on acquisition accounting separately, as well as on the common control transactions as well. Now, once you apply the concept and decide that it is a case of acquisition accounting, I broadly divide the entire accounting into a total of 7-step model. Though, of course, the steps may vary from person to person, but I think it's the best idea that when you do a full-fledged question on Ind AS 103, there is a total 7 steps one could apply in a chronological order. You call them as working notes, or you call them as steps. That's one and the same thing. The step number one is to, first of all, identify, you can say, the date of acquisition. The second step is to identify what we call accounting acquirer. The third is making a list of the net assets. The fourth step is the calculation of the purchase consideration, which the acquirer paid to the acquiring shareholders. The fifth step is to calculate the NCI. The sixth step is to calculate the goodwill. And finally, the seventh step is to put the acquisition entry. I'm just, giving you a little recap in terms of, connecting you to the standard. Now, in the examinations, questions in India's 103, the examiner may ask you a full-fledged question where you'll end up applying all the 7 steps in a go. Or there is a possibility that there might be an independent questions on any one of these steps. But I think if you technically ask me, which steps generally the questions would come. So I would say, the major questions which can arise is out of step number 3, which is making a list of the net assets. It could be in terms of purchase consideration, that is the calculation of the PC. And maybe, when you're doing questions, when you get those MCQs, you could get questions in terms of calculating NCI or as well as calculating a goodwill as well. But I think if you're looking at, a little more subjective questions, and even of course MCQs, the questions could be concentrated largely on the calculation of the purchase consideration, because there are a couple of agendas which are related to the concept of purchase consideration. So as we move, as we've been doing in the previous sessions as well, we'll keep making some quick mind maps also. So I think with that quick inputs in terms of just, reminding yourself in terms of what are the various elements as far as 103 is concerned, let's, I think, begin the journey. So what I'm going to do, first of all, do a small question with you, which is also in the study material, and this is on the concentration test. So let me just share the screen to you, and let's have a look at the question. So I guess let's have a look at, first of all, the question number 1. So we're just going to have a look at the question number 1 in this case. Now, the first thing what I'm doing, I'm just reading the requirement of the question. It says entity A needs to determine whether acquisition is an asset acquisition as per the concentration test. So the idea is only to evaluate whether the concentration test is being met or not. So I think let's now read the facts of the case. It says entity A is having a 20% interest in entity B. Subsequently, it further acquires a 50% share in entity B. Now, one thing is very clear, that if you've got a 20% interest, initially you had a significant influence. And when you acquired another 50%, then 20 plus 50 makes it the case of control. So I think you would also recall that this 20% is called PHI. That's called the previously held interest. And you've acquired another 50% stake, and that is to the extent of 300 crores. Then it says the fair value of the assets acquired and the liabilities assumed is given. So I am given the building is 1000 crore. The cash is to the extent of 200 crores. And there are financial liabilities of 800 crores. And there is a DTL, that is a deferred tax liability, 150 crores. Then he says the fair value of the entity B is supposed to be 400 crores and the fair value of the NCI, because 20 plus 50 makes it 70%. So we can say 30% is the NCI. So 30% of that 400 crores, that makes it 120 crores. So we're given the fair value of the business as a whole, and we're also given the fair value of the NCI. Then he also tells you that the fair value of the previously held interest, that is PHI, that is 20% of 400 crores, that comes to 80 crores. So I think the data is given pretty well. Now you need to apply the thoughts that when you apply the concentration test, I would say that when you present your answer, you need to be very careful in terms of your calculations. Now, what am I supposed to do? Let me, I think, begin the journey. Let me share the board as well. So as I do the question number one. Now, what should immediately come to your mind is, I think, let me just quickly remind you how you're going to make your calculations. I think when you apply the concentration test, it would be a good exercise to apply a simple three-step. I generally, keep always applying the three-step model. So in this particular case, when you're applying a concentration test, you can apply a simple three-step model. In the step number one, you need to get what is called gross value of the assets. So we need to calculate the gross value of the assets. The step number two, you need to identify that which is that single asset or which is that group of similar assets where we can say is got the highest fair value. You need to pick out of all the assets, which particular asset, or you can say which group of assets which are similar in nature is got the highest fair value. And then in step number three, you need to see that particular asset, the fair value of that particular asset, is it substantially equal to the gross value of the assets or not? And if the percentage is substantial, though there is no definition what is substantial in nature, we generally consider, let's say, for example, if it is more than 90%, we would say, yes, it is substantial in nature. So I think let's begin the journey. So what we're going to do, first of all, in this particular case, as I made a mention, I need to first of all do the calculations in terms of calculating the gross value of the assets. So let's first of all calculate the gross value of the assets. So I'm going to call this as step number one, calculating the gross value of the assets. Now, how would you calculate the gross value of the assets? I would say you need to consider a total of three elements. You need to consider the sum total of number one, the purchase consideration. You need to add the amount of PHI, that is previously held interest, and you need to add the amount of NCI. I think as we move forward, let's also keep reminding the logic which is there in terms of these calculations. Now, when you consider the purchase consideration, we paid a consideration for 50%. Then there is a previously held interest, which is 20%. And the NCI is to the extent of 30%. So when you take the sum total of all these three elements, it makes it equal to 100%. And let's get the data and let's first go back to the question again. So we can say that it says entity A acquired 50% shares by making a payment to the extent of 300 crores. So the PC is to the extent of 300 crores. And as far as the PHI is concerned, if you go back, the PHI, it very clearly says in the end, is to the extent of 120 crores. And the NCI is to the extent of 80 crores. So this is 120 crores. And this is to the extent of 80 crores. So let's add all these three elements. So if we did the sum total of 300 plus 120 plus 80, that makes it a total of 500 crores. I think let me also ask you a quick question now on this. Once you add the sum total of these three elements, that is PC, PHI, and NCI, is this equal to the amount which is paid for the assets, or is this the amount which is paid for the net assets? I think that's how, accordingly, we'll decide the changes which we are required to do. So the question goes to you, is the sum total of all these three elements the amount which is paid for the assets, or is it the amount which is paid for the net assets acquired? Let's get the answer from your side. Okay, I'm still waiting for the answers on that. Okay, I think I'll have to answer that. Well, your purchase consideration is always paid for the net assets acquired. So even when you add these three elements, you get the sum total of what is paid for the net assets. So in this particular case, this 500 is what is paid, you can say, for the net assets acquired. Now, in this particular case, what we need to do further, make some further calculations as well. So what do you need to do? First of all, you need to add the liabilities to this, because this is what is paid for the net assets. And when you add back the liabilities, you're going to get what we have paid for the assets. So let's go back to the question and let's see what is the amount which is paid as far as the liabilities are concerned. So we're given that the amount which is paid as far as the financial liabilities are concerned, that is to the extent of 800 crores. So we go back and add the liabilities to the extent of 800 crores. So you can say once you add this up, you get 1300 crores. Can I say this is what is paid for the assets? This is paid for the assets. Just keep the thoughts very clear. 500 crores is what is paid for the net assets. And then when you add liabilities, you get what is paid for the assets. Is there anything else which needs to be adjusted in that 1300 crores? Because when you look at the assets acquired, we've acquired building, we've acquired cash and cash equivalents. So any elimination to be done from this 1300 crores? I don't know whether I'm going to get the answer on that or not. So I think let me tell you that we need to make a reduction in terms of cash and cash equivalents. That's rightly said. Because when you're looking at the cash and cash equivalents, you paid exactly what is the value of cash and cash equivalents, and that is to the extent of 200 crores. So this is going to give us a total of 1100 crores. So this is your step number one, that you're able to calculate what is the gross value of the assets. So remember, in step number one, you need to basically apply sub step three. One is you calculate the sum total of the PC, NCI, and the PHI. Then you need to add the liabilities, and then you need to reduce the cash. Then we go on to the step number two. Can I say now, in terms of step number two, you need to make a scrutiny of all the assets acquired and see which asset has got the highest value. I guess out of all the assets, it is pretty clear that the building is 1000 crores. So that seems to be the only asset which has got the highest fair value. So we can get the building is to the extent of 1000 crores. Then I think it is simple. In the third step, you just need to calculate a percentage. So we can say the building acquired is 1000 crores and the fair value of the gross assets in step one is 1100 crores. So when you take the percentage, let's see what is the value. 1000 divided by 1100, that works out to approximately 91%. And can I say in this particular case, is this figure substantial? Can we say the company paid almost 91% consideration practically for the building? Does the concentration test pass? Yes, that is right. So the concentration test passes in this particular case, and therefore the conclusion easily comes that it is not a business. We can say it is supposed to be an asset acquisition. So therefore, Ind AS 103 is not applicable. So I think that was a quick revision in terms of identifying how the concentration test is applied. Wonderful. I don't think so. I really need to make any mind map at this particular stage, because I think in this particular case we have already, done the calculations in bits and pieces. Right. So far, so good. Okay. Now I think let's go to the next agenda. The question number one is done. Now I'm going to go to the questions concentrated in terms of the purchase consideration. But let us, I think, take a little recap as well, because I'm not taking questions on the identification of the date of acquisition, because invariably, when you look at larger questions, the date of acquisition is already given in the question, so that's not an issue. And similarly, I've not taken questions on identifying the accounting acquirer, but I think that's a very crucial exercise, because when you identify the accounting acquirer, it tells you whether it is a case of acquisition accounting or it is a case of reverse acquisition. Because you need to see that once the consideration is given, ultimately the control is with whom? Because it may happen that you pay the consideration, but in spite of the fact that you pay the consideration, the entity which gets the consideration is ultimately getting a control, and that becomes a reverse acquisition. So I think we are not spending time in terms of the two initial easy steps. I think let's start working on the concept of purchase consideration. You want me to first of all make a little mind map initially on the PC or later? I think later. But I think you'd like me to at least give you a quick recap in terms of what are the various elements which goes in the purchase consideration. So a basic discussion. I think yes. So I think before we move forward, I think I'll just like to do a quick inputs at this stage. Let me just come back to the board. And I think let's quickly connect some few dots at this stage. Now, I'm going to do a couple of questions with you, which is based on the calculation of the purchase consideration. Now, I think it's going to be on a safe side. Before I discuss further, I just want to, keep something at the back of your mind, because as we calculate PC, I think we should have these crucial inputs in the back of the mind. I would say per se, when you look at the calculation of the purchase consideration, generally, the PC is paid in the form of cash and the PC is paid either in the form of shares. Generally, these are the two forms of payment. Either you pay cash to the shareholders of the acquiring company, or you may give them a share exchange. You may issue shares in your own company for the shares acquired. And when you consider the shares, you need to consider the fair value of the shares which are issued for the purpose of PC. Now, I would say, apart from this, when you calculate the purchase consideration, there are a total of 7 issues which you need to keep in mind. I think in a comprehensive question, when you calculate a purchase consideration, I would say there could be a total of 7 comprehensive issues which you need to filter out when you calculate a purchase consideration. The first one is what we call a deferred consideration. And I'm just taking a very quick view before we start doing questions on individual questions on a purchase consideration. Now, when you say that there is a deferred consideration means something which is going to be paid in the future. And when it is going to be paid in the future, you need to consider the present value of the future payment. So when it comes to a deferred consideration, you need to consider the present value of the future payment, which is nothing but called the value. And also remember one thing, that when you consider the purchase consideration which is deferred, there is also going to be unwinding of discount in the future. Because when you consider a present value anywhere in the Ind AS, remember, it always leads to unwinding of discount in the future. So this is going to lead to, you can say, unwinding at a future date. The second interesting part is what we call CC. That is called a contingent consideration. Now, there are two types of contingent consideration. One is a contingent consideration which is paid in the shareholder's capacity, and one is a contingent consideration which is paid in the employee's capacity. Now, when you say contingent consideration, it is something which is payable in the future, but it is based on certain terms and conditions. As far as a DC is concerned, it is paid in the future, but it is definitely paid. But when it comes to a contingent consideration, it is something which is paid in the future, but is based on ifs and buts. It is something which is, dependent upon the conditions met. And when you consider the contingent consideration, you need to see the parameters on which it is based. So, for example, if you are going to give a consideration, But this consideration depends upon employment. You tell the shareholder of the acquiring company, who is also the employee of the acquiring company, to put in certain years of service. And you tell him that you're going to give him a consideration only if he's going to work for a certain number of years. Then it becomes a contingent consideration in the employee capacity. But if there is any consideration which is paid, which is not based on employment, but any other parameters, then it would be a contingent consideration in the shareholder's capacity. If it is going to be a CCS, that is shareholder's capacity, you consider the fair value as a part of the PC. But if there is a contingent consideration paid in the employee capacity, we do not consider it as a part of the PC. I think invariably you can get anywhere in questions on a DC, on a CCE, or on a CCS. And accordingly, you need to be crystal clear on the concept. Apart from this, the next one is what we call TC. That is called a transaction cost. Now, when you consider a transaction cost, it is never taken as a part of the purchase consideration. That would be given in the question, but it is not to be included in the purchase consideration. The next element is what we call PHI, that is called the previously held interest. And this is similar to what we did in the previous question when we were doing a concentration test, where we said that you need to update the PHI at the fair value. So when you consider the PHI, it is to be taken at a fair value. And any differences between the book value of the in PHI and the fair value is accounted in accordance with the circumstances. We are not, I think, considering that. I'm just giving you a fair, broader overlook. The next agenda in terms of the purchase consideration is what we call SBP. That is called a share-based payments. So we'll see when we come to the concept of share-based payments, but this is also taken as a part of the PC, but it is taken at a proportionate amount of the fair value. So it is taken at a fair value, but this is not at complete fair value. It is supposed to be something which we can say is a pro rata fair value depending upon the vesting period. I think that makes it a total of 6. DC, CCS, CCE, TC, PHI, share-based payment, SBP. And you also need to watch out the concept of any pre-existing relationship which is to be adjusted in terms of the purchase consideration. I think if you get crystal clear on the concept that these are the 7 agendas which impact the purchase consideration, I think life is going to be simple. I thought, before we start doing questions on the calculation of PC, let's give you that basic overview. I think it was a good idea, wasn't it so? Though I didn't discuss technical nitty-gritties in this particular case, but I think still on a broader level, I just thought let's give you at least the agendas in mind as you calculate the PC. Now I think we'll come to the practical practice on the purchase consideration. So let's have a look now at the question number 2. This question number 2 is from the education material. It also came in the RTP in November 22 as well. Okay, let's, I think, read the inputs what are given in the question. How should a contingent consideration payable in relation to business combination be accounted on the initial recognition and on the subsequent measurement in the following cases? So I think the question is very clear that it is definitely a case of CC. But I think we need to identify still that whether it is a CCE or is it supposed to be a CCS. But he's asking for the accounting treatment initially as well as subsequently. Let's go forward. So I'm given in the point number A. It says on 1st April 2016, it says A acquires 100% interest in B. So we're given that A in this particular case, let me just use the pen back again. So it says A acquires 100% interest in B. As per the terms of the agreement, the PC is paid in two tranches. There is an immediate issuance of 10 lakh shares with a face value 10 per share. Then there is a further issuance which is 2 lakh shares after a period of 1 year, and it says if. So there is a payment in the future, but that is dependent upon certain terms and conditions. It says if the profit before interest and tax for the first year exceeds 1 crore. By the way, is this CCE or is this CCS? He's very clear that the shares are to be given after 1 year. It's a future payment, but it also says that it is based on the parameter if the profits before interest reaches a certain target. So is this a CCE or is this a CCS? And that's absolutely correct. It is undoubtedly CCS because the condition is not on the future employment in this particular case. Let's read further. Then he says the fair value of the shares on the date of acquisition is 20 per share. Further, the management estimated that on the date of acquisition, the fair value of the contingent consideration is supposed to be 25 lakhs. Now, this is the information which is given as far as the acquisition date is concerned. Then he says during the year ended 17, the profit of B Limited exceeded 1 crore. The consideration is met. As on 31st March, the fair value of the share is now 25 per share. Now it says in part number B, continuing the above pattern in A, except the number of shares to be issued after 1 year is not fixed. Earlier, in the above example, we were giving a total of 2 lakh share, which is a fixed number. And now it says, assume that we're going to give shares, but not fixed, but it's going to be variable in number. Rather, A agreed to issue a variable number of shares with a fair value equal to 40 lakhs after 1 year, if the PBIT for the first year exceeds 1 crore. Okay, so I think now the question what comes to the mind is, before we solve the question, I think let's quickly take inputs on this case. The first thing is that when you consider the contingent consideration, it is initially measured at a fair value. Now the question rises, what is the treatment on a subsequent level? I think let me say something, you can maybe vouch me on that. Can I say you need to identify that the contingent consideration is supposed to be equity instrument or a financial liability as per Ind AS 109. Is my thought correct? The subsequent accounting treatment of a contingent consideration is dependent upon the fact whether it is supposed to be a financial liability or it is supposed to be equity instrument, right? Yes. And once you decide that it is supposed to be a financial liability, then in that particular case, you need to measure the CC at a fair value through profit and loss account. So any changes in the fair value is going to be taken in the profit and loss account, provided you've classified it as a financial liability. On the contrary, if you say that the contingent consideration is supposed to be equity instrument, then in that particular case, it is not to be restated. That means we will not consider any fair value measurement. So which means that when you consider the initial measurement, it is at the fair value. When you go to the balance sheet date, it all depends upon whether it is a financial liability or it is supposed to be equity instrument. If it is equity instrument, no updation of fair value will be required. And if it is supposed to be financial liability, then it is going to be remeasured at a fair value. Do you vouch me for this input? I think definitely yes. Then I think let me put some one or two quick questions further on this. I'm going to put three questions to you. You need to quickly decide, is it a financial liability or is it an equity instrument? If the consideration is paid in cash, CC, I'm talking of CC. If it is paid in cash, FL or equity. If you're going to pay the CC in terms of cash, then is it FL or is it equity? I thought I'm going to get quick answers on that. And that's right, it becomes FL. Good. Next, if you're considering the payment in terms of fixed number of equity shares, FL or equity. The payment is in equity shares, but it is fixed in number. So it's going to be equity or is it going to be FL? We need to basically apply the parameters of Index 32 in terms of deciding the same. It is going to be equity in nature. And if you're going to give variable number of equity shares, I think I can answer that. It becomes a financial liability. So which means if it is cash, financial liability, if it is variable equity shares, financial liability, if it is fixed number of equity shares, it is equity instrument. So I think let me just come back on the question and now we can just give the solution as well. So in the part number A of the question, there is an immediate issue of shares, that's one, and there is a further issue of fixed number of shares that makes it equity instrument. But in the part number B, he gives you that the variable number of shares will be issued that makes it financial liability. So let me now organize the solution. So let's, I think, solve this out. Let me just take it back. Let me just share the screen back again. So let's, I think, solve this out. So in this particular case now, that is in question number 2, we're going to first of all calculate the, you can say, purchase consideration, and we need the calculations initially. So for the initial purpose, there are two portions on the calculation of the PC. One is immediate issue of shares, and one is the further issue of shares. And this further issue of shares is fixed number. So I think making worth mention that it becomes an equity instrument, though it does not make a difference for the purpose of initial calculation, but it makes a difference in terms of the subsequent one. Now let's go back to the question and let's see what is the value of the shares initially issued. So it says that as a part of the consideration, immediate issue of 10 lakh shares, and the fair value of the share is supposed to be 20 rupees per share. So we are issuing a total of 10 lakh shares and the fair value is 20 rupees per share. So I think this works out a total of 200 lakhs. Now let's go on to the further issue of shares. There is going to be a further issue of 2 lakh shares, and then it says in the para below that, it says that the management is estimated that the fair value of the contingent consideration is 25 lakh. So we consider the fair value of the CC. So we can say the total purchase consideration that works out at 225 lakhs. Simple and straight. So we've taken the sum total of the shares immediately issued at the fair value, and we've also taken the CC at the fair value itself. Now, let me, I think, put the next question to you. This is for the part number A. Now we're looking at the subsequent accounting. Now, considering that we are issuing a fixed number of shares, let me, I think, put the question back to you. Are we going to consider any fair value changes, or are we going to ignore the fair value changes considering it is classified as equity instrument? What do you say? Though I think I've conceptually given you all the parameters, but I think still let's put that question back to you. So if you are giving a fixed number of shares, would there be any changes captured in terms of fair value? Yes or no? Okay, I think I'll have to answer that question as well. The answer is a big no, because once it becomes an equity instrument, in that particular case, we are not required to restate. So there will be no changes. There will be no changes in fair value, which is captured. So this is with reference to the part number A. Now let's go to the part number B. The initial calculation, of course, remains the same. But I guess if I look at now the accounting subsequently, now we are giving a variable number of shares, and when you give a variable number of shares, you can say it becomes a financial liability. So let's come back on the question. So in this particular case, it says, continuing the above pattern, the number of shares are not fixed, but it is variable, and the fair value is now equal to 40 lakhs. So earlier, the fair value was supposed to be 25 lakhs. So we can say initially, the fair value was supposed to be 25 lakhs, and we can say on the balance sheet date, the fair value is supposed to be 40 lakhs. And since it is a financial liability, in technical words, you can say you need to recognize this financial liability measured at FVTPL. So which means the fair value changes of 15 lakhs, which is supposed to be a gain, is going to be taken where this amount of gain is going to be credited to the profit and loss account. Right, friends, I hope we got the points. Question revised well. Should we now make a little mind map in terms of the contingent consideration? Do you want me to map this up? Because I think this is a crucial point. So do you want me to map this? That what are the treatments in terms of CC, various permutations and combinations? Yes, let's, I think, do that. So I think let me just make a quick mind map number one for the day. So this is my first mind map for the day, mind map one. This is purely on the concept of CCS. So this is the mind map we are making in terms of CCS, contingent consideration, which is paid in the shareholder's capacity. Now, what do we need to do? I think let's first of all take a column initial, and let's take a column subsequent. So when you look at the initial, we can say undoubtedly it is captured at fair value. Subsequently, it all depends upon the classification. Subsequently, it depends upon the classification. And this classification will be, can I say, as per financial instrument standard, there is Index 32. And in this particular case, we can say it is either a financial liability or it is equity instrument. And in which cases will it be a financial liability? If the mode of payment is supposed to be cash, or if the mode of payment is supposed to be variable number of shares, in those particular cases, it'll become a financial liability. And if the mode of payment is supposed to be fixed number of shares, then it becomes an equity instrument. So which means for subsequent accounting, your mind should be working in terms of classifying this, whether it is a financial liability or it is supposed to be an equity instrument. So when you say it is a financial liability, it is measured at FVTPL. And when you say it is measured at FVTPL, we're indirectly saying that the fair value change, whether it's a gain or whether it's a loss, is going to be captured in the P&L. And when you say that it is fixed number of shares, then there is no changes to be captured. There are no changes to be captured. We're not going to consider any fair value changes in this particular case. Wow. So I think that maps up a mind on one of the crucial elements of the purchase consideration, and that is CCS. because CCE in any case is not to be taken as a part of the purchase consideration. So our focus is in terms of CCS. Okay, that is done. Now I think let's go further. So we're going to take some more questions now on the calculations of the purchase consideration. And I think before we discuss further, I think, first of all, take you further and give you some inputs on the next agenda of discussion. The other area which has been, very well tested in the exam, and invariably, you get some good, decent questions in the exam, and that is on the concept of what is called PHI. I am again thinking to give you some inputs before we solve a question on the PHI. Then I think we can make a mind map on that a little later. Because I think if you ask me, there are two technical areas in terms of purchase consideration where you can get, independent questions. CCS is one of them. And I would say the PHI, or maybe share-based payments also, but PHI, of course, definitely yes. Now, let's, I think, first of all, connect the dots. When you consider the case of PHI, that means as an acquirer, you already had a certain stake in the acquiring. It could be a case of a passive investment, which was being accounted under Ind AS 109, or it could be a case of a significant influence, which was accounted under Ind AS 28. Now, in any case, whether you were earlier under 109, a passive investment, or you were under Ind AS 28, a significant influence, the first thing what you need to do is you need to update the PHI at a fair value. But then the question arises, what do you do with the fair value gain or loss which arises on the updation? Well, if it was accounted under Ind AS 109, it was a case of passive investment under 109, your mind should immediately tell you that, okay, it was either accounted at FPTPL or it was accounted under FPT-OCI. If it was accounted under FPTPL, the gain or loss will go in the P&L. But if it was accounted under FPT-OCI, then the gain or loss will be taken in OCI. Because equity investments under Ind AS 109 are always accounted at a fair value, but they may be accounted at a fair value through P&L or fair value through OCI. So accordingly, if it was accounted under FPTPL, the gain loss goes in the P&L. If it is accounted under FPT OCI, the gain loss goes in the OCI. Next, if this investment was accounted under the equity method, then in that particular case, any gain or loss on a fair value updation will be taken in the P&L. But the interesting input on which the question comes and has come in the exams as well is the area when you say that you were accounting for the PHI using equity method under Ind AS 28. When you were applying the Ind AS 28, there is equity method of accounting. You must have done the entry investment debit P&L credit, investment debit OCI credit. So there will be a cumulative balance in the other comprehensive income as well. So the question is, what do you do with that balance which is lying in the other comprehensive income? I think if you've seen the detailed lectures, you would definitely recall that you need to make a scrutiny in terms of other comprehensive income. The other comprehensive income needs to be scrutinized, and you need to see, is that amount accumulated in the OCI is supposed to be a case of R, that is recycling, or is it a case of NR, there is no recycling? If it is a case of R, you are going to transfer that amount in the profit and loss. And if it is a case of NR, then that amount is to be transferred in the retained earning. So I think what is most important in this particular case is that when you are considering the equity method of accounting for the PHI, updation at the fair value is first of all captured at a fair value. And the gain or loss will all depend upon, in terms of equity method, it goes to the P&L. But I think the main crucial point is the scrutiny of the balance in OCI. Due to the application of the equity method, there is a balance which is there in the OCI that needs to be scrutinized. So I hope you've been able to connect some dots. I thought before I take you to the question, let's connect the dots. We'll make the mind map summary later. Let's now come back to the question once again. So we're looking at the question number 3, and this is a question which came in the exams. June 2019, it came for 8 marks in the exam. A similar question is there in the study material as well. And this is, if I remember rightly, a similar kind of question is there in the education material also. And it's a brilliant question on the concept of PHI. Let's read. Let's first read the inputs. So I am given the inputs out here. It says Deepak, an automobile group, acquires 25% of the voting ordinary shares of Shaw, another automobile business, by paying 4320 crores on 1st April 17. Deepak accounts for the investment using equity method prescribed under Ind AS 28. Now, initially, you acquired a 25% stake in the company, that is a PHI, and since it is more than 20%, it gives you a significant influence, and therefore it is accounted under Ind AS 28 using equity method. Then he says on 31st March 18, Deepak recognized the share of the net assets using the equity accounting as under. So what he's done, since he's applied the equity method of accounting, so what he has done in this case, he's recognized the share in the profit loss, he's recognized the share of exchange difference in the OCI, and he's also taken the share of the revaluation reserve in terms of PPE. Which means what? If he's recorded the share in the post-acquisition movements in terms of P&L and OCI, he would have done the entry investment debit P&L credit, investment debit OCI credit. And that's what it says. The carrying amount of the investment is 4779. To the cost of 4320, what he's done, he's added the share in the profits and added the share in the OCI. So indirectly, the equity method of accounting is being given in the question, where every subsequent accounting investment got a debit and the corresponding credit in the P&L or the OCI. So one thing is very clear, that due to the application of the equity method, you can say there are two balances accumulated in the OCI. One is the exchange difference arising on account of Ind AS 21, and one is a revaluation reserve, which is accounted as per Ind AS 16. Quick questions coming to you very soon. Then he says on 1st April 18, Deepak acquired remaining 75% of Sean for a cash of 13,500 crores. The fair value of that 25% interest is 4860 crores, and the fair value of the net assets is also given 16,200 crores. So we're given the fair value of the net assets, we're given the fair value of the fair value of the PHI as well. How should the business combination be accounted in accordance with the applicable Ind AS? Now, I think before we solve the question, two quick questions coming to you. When you say that you've taken the exchange difference as per Ind AS 21, would you like to tell me that this is a case of OCI-R or a case of OCI-NR? So we're looking at the exchange difference, Ind AS 21. So case of recycling or no recycling? Any inputs on that, friends? Is it a case of R or a case of NR? And that's right, he said, it is a case of OCI-R. Wonderful indeed. And as far as the revaluation reserve is concerned, I think I can tell you it is supposed to be NR. Which means when you're going to update the PHI, in this particular case, any balance which is there in OCI-R will be transferred in the PNL, and any balance in OCI-NR is going to be transferred in the retained earnings. Now, I would advise when you do a question on the case of PHI, my advice is nobody will document that later as well in the mind map, but what I would advise, you should make three separate entries so that you do not go incorrect. I would say that it is more logical to make three separate entries so that we do not go incorrect in this case. Now, what are the three entries which you need to make? I would say number one, you should update the fair value of the PHI, and whatever is a gain or loss that can be taken in the P&L. The second is, I would say, you can now consider the scrutiny of the OCI and decide what amount is to be taken in the P&L, what amount is to be taken in the retained earning. And then I would say the third entry is putting the acquisition entry in terms of Ind AS 103. So I would say do not merge everything in a single entry. That you consider the fair valuation gain also, you take the scrutiny of the OCI also. It is better you go in a chronological order, update the fair value, get the gain loss in the P&L. Make the scrutiny of the OCI and see what is to be taken in the P&L and RE, and then put the acquisition entry. So what I'm going to do in this particular case, put my entries in three parts. So let's see question number 3. Let's solve this out. So I am looking at now the answer to the question number 3. And we're going to solve this, as we said, in 3 different parts. First of all, I think let's consider what is the book value of this investment and what is the fair value of this investment. So we want to compare, first of all, the book value and the fair value of the PHI. So let's go back and we can clearly see the carrying amount of the investment is 4779. So the book value of the investment is 4779. And I'm also given very clearly, it says fair value of the 25% interest is 4860. That works out at 4860. So there is a gain which is arising on account of the PHI revaluation, 4779 versus 4860, that comes to 81 crores gain. So what is the entry which I am supposed to pass at this stage? Investment gets a debit, profit and loss gets a credit, and this entry can be done at 81 crores. So I would say this is one focus point. Go step by step and you will not go incorrect. Let's now go to the next one, second entry. Now it's time to do the scrutiny. Now it's time to do the scrutiny of the other comprehensive income balance in this particular case. So let's go back to the question. So we can very clearly see that there is a share in the profit and loss. Well, that doesn't make a difference to me because what is gone, the P&L is gone. I'm only concerned with the exchange difference, 54. Now, when it says that there is exchange difference in OCI, what is the name? What is the name with which it appears in the statement of changes in equity? Would you like to tell me? Because when you take something in the OCI, it is accumulated in SOKI and it is accumulated with an appropriate nomenclature. The revaluation reserve is already given as a nomenclature. Would you like to tell me where do you park that exchange difference when you apply Ind AS 21? Which particular head it is put across? Any inputs on that? Whatever goes in the OCI is accumulated in the tab number 3 of SOKI. So which particular head do you put that? Any inputs on that? I think I'll have to answer that as well. Let's go to the FCTR, Foreign Currency Translation Reserve. Because when you apply the concept of Ind-AS 21, and therefore we are not going to say OCI, we're going to call this as FCTR. So I think let's come back on the agenda. So we can see in this particular case, there is a balance in terms of FCTR, which is a case of OCIR, and there is a balance in the revaluation surplus, which is a case of OCI-NR. Let me note down the difference as well. So that's 54 and that's 27. So we know that this 54 is going to be put in the P&L and this 27 is going to be put in the retained earning. So let's put entries for that. So we can put the entry FCTR gets a debit, which is nothing but OCI, and the profit and loss gets a credit. That is to the extent of 54 crores. And then the revaluation surplus gets a debit and the retained earning gets a credit. And this is to the extent of 27 crores. So you can see I'm going absolutely step by step on a logical manner. And if you notice, the first thing which I did, I took the fair value changes of the PHI. The second input which I did, I took the concept that let's scrutinize the OCI and get the differences. Then comes my third entry, and that is the entry which is acquisition accounting. Go step by step because your focus also remains in terms of what is to be done. Trust me, if you keep your focus very clear in terms of what is done at each stage, life jingalala. So now let's go to the acquisition accounting, in which case we need to consider the net assets. And we need to consider the P purchase consideration. And this can be taken including the PHI. Let's now go back to the data. In the last para, it tells you that as far as the net assets are concerned, the fair value is 16,200. So we get the fair value of the net assets, 16,200. And as far as the purchase consideration is concerned, I guess if I go back, so we acquired, I guess, what is the purchase consideration paid? So we've acquired 75% shares at 13,500. And we need to consider the fair value of the PHI. And we've also seen that the fair value of the PHI, that is 4860. So we get this 4860. Now we can see the difference in this entry. 13,500, 4860. Vis-a-vis 16,200, it comes to 2160. This is the balancing figure, and this is going to be called as goodwill. There is no NCI in this case because we acquired 25% stake and then acquired another 75% stake. So there is no NCI. Otherwise, in the entry, we would have taken a credit to the NCI as well. So far, so good. I think this is another interesting question on the concept of PHI. You want me now to make another mind map number 2 on the concept of PHI, moving from a case of a passive investor to control and moving from the case of cigarette influence to a case of control and looking at what are the inputs to be done. Make up number 2 as well on this. Okay, yes, of course. So I think let's make another quick second mind map for the day. So let's make a second mind map on this now, which is on the PHI. So this is my mind map number 2. And in terms of this, my focus is completely on the PHI, previously held interest. Now, I would say in this particular case, there will be a total of 2 permutations and combinations that would follow. So one is the case where we can say that it is a case of a conversion from a passive investor to the case of control. And when we say that it is a case of conversion from a passive investor to the case of control, then in this particular case, we can say We were applying Index 109 earlier. So all your accounting treatment is dependent upon whether you were accounting the equity investments at FPTPL or was it accounted under equity OCI. So in this particular case, the questions will give you the instruction whether it was accounted under FPTPL or whether it is accounted under FPT OCI, which is always a case of no recycling. Now, if it is a case of FPTPL, then any fair value changes, whether it's a gain or whether it's a loss, will be captured in the P&L. And if it is a case of FPT OCI NR, any fair value changes will be taken in the OCI. I think let me ask you a quick question now at this stage further. Can I say even in this particular case, there will be an accumulated balance in OCI, right? So would you like to tell me where will you take that accumulated balance in OCI? Is this going to be taken in the P&L or is this going to be taken in the retained earnings? Because when you would be accounting for this investment under Index 109, you would have captured all the fair value changes in the OCI. So what do you do with this accumulated balance in the OCI? P&L, or are you going to put this in retained earnings? Absolutely correct. We're going to put this in retained earnings. This is, I would say, the case number one. Wonderful indeed. Now we go to the next input. The next situation is a conversion from a significant influence to a case of a control. So you were having a significant influence over the investee, and now you achieve a control in this particular case. Now, when you were influence, you were covered under Index 28. And in this particular case, we would have accounted under what we say the equity method of accounting. And now in this particular case, I would say that you need to go 3 stages. I would say you need to go for 3 stages. Number one, what do you need to consider in this case? Compare the book value as per equity method. You need to compare the book value as per the equity method versus the fair value. And this is one thing which we did an entry, and this gain or loss is going to be taken in the P&L. That's what we did our first entry. You compare the book value as per the equity method versus the fair value, and that gain or loss enters the P&L. Number two, you need to make a scrutiny. You need to make a scrutiny of the accumulated balance in OCI. You need to make a scrutiny of the OCI accumulated balance in the other comprehensive income. That is the agenda number two. And in this particular case, once you make a scrutiny, you get the inputs. Either it is supposed to be a case of OCI R, or it is a case of OCI NR. And I think by now you will be very clear. Once you look at the balances, what is R and what is NR, you'll definitely get the picture. If it is a case of OCI R, this will be transferred to the P&L. And if it is a case of OCI NR, then this will be put in the retained earnings. Though I'm putting the acquisition entry as 0.3, but that's, I think, part of the acquisition accounting. So I would say this is what you need to do with reference to PHI. But I'm still going to put that, and then comes your acquisition entry. Though acquisition entry is not a part of the PHI, this is to be done in a usual manner. Wow. So you can notice that, you might find our discussions going very technical since morning. But since, what the idea is, we are basically doing questions which are more technical in nature. The idea is not to, do revisions on simple things. The idea is to do the revisions on complicated part. So I think you're finding that the levels are a little technical since morning. Good. I think that is definitely good. Right, friends, so far so good. I hope you've been able to catch up with the concept. I hope all the nitty-gritties are flashing at the back of your minds. We're going good. The pace is good. I think you're able to connect the dots in terms of the various crucial issues in 103. The journey has just started. There's a lot more to go. Technical, is it? I would say interesting. Rather than saying technical, I would say it is interest on the way. Okay, let's, I think, now go further. So let's now go to another element in terms of the purchase consideration. Because my focus is on the purchase consideration, which is step 4, where I've dealt with questions on a CCS, I dealt with questions on a PHI. Now the next agenda is looking at the concept in terms of mandatory replacement, SBP. Now we know that many a times the acquirer may replace the share-based payment awards of the acquiring company. He may tell the shareholders of the acquiring company that I am going to replace the awards, and this becomes a mandatory replacement. In which particular case, we need to consider a pro rata value, a pro rata fair value as a part of the purchase consideration. And how do you calculate the pro rata value? You need to consider the fair value as on the date of acquisition. By the way, what do you take? Do you take the fair value of the original award, or do you take the fair value of the replaced award for the purpose of the pro rata calculation? I think let's put that question to you. So what do you do in this particular case? Do we consider the fair value of, do we consider the fair value of the, you can say, original award or the replaced awards? What do you say? Are we supposed to consider the fair value of the replaced awards or the fair value of the original awards for the purpose of share-based payments calculation? I think I'll have to answer that as well. So we're going to consider the fair value of the original award, because we need to consider fair value of the original award and take a proportion. And that proportion is the vesting period completed upon, you can say, the total or original vesting period, whichever is greater. I think let's come back to the agenda now. I'm just going to share the question back to you. So let me just share the question. We'll make the mind map later. Let's, I think, first go back to the question. So we're now on the question number 4. Now, in terms of the question number 4, let me first read the requirement of the question. Determine the amount which is attributable to pre-combination service and post-combination service. So we're looking at the split between what is the pre and the post-combination service in a situation. It says in a situation where all the employees are expected to meet the service condition. So let's read the facts of the case. It says on 1st April 14, company ABC granted equity settled share-based payment awards with a grant date fair value, which is 1 lakh to the employees, which is subject to a 3-year service condition. The company XYZ acquires the entire shares of ABC on 1st April 16 as a part of the acquisition agreement. So the acquisition, the ESOPs were issued on April 14, and the business combination occurred on April 16, which means 2 years have already elapsed. So we can say out of 3 years of service, 2 years of vesting period is already completed. Then he says on the date of acquisition, the market-based measure of the original award is given, 1,80,000, and the market measurement of the replaced award is given, that's 2 lakh. Now it says the replacement awards have a 1-year vesting condition. So the acquirer company did not change the period of vesting. So he said the remaining vesting period is going to be 1 year. So there's been no change in terms of the original vesting period. Now, one thing which I would like to pinpoint is, when it started off, it very clearly said that ABC granted these ESOPs, and then it says you acquired the business combination. Then he says it is required to issue. When you say it is required to be issued, that becomes a mandatory replacement. When it is a case of a mandatory replacement, we need to apply the proportionate fair value of the original award. I think let's solve this out to you now. So question number 4. Now here again, I would say when you're looking at a calculation of a share-based payment, I would say you can again apply a simple 3-step model. Let me share the inputs. Then we'll make a mind map on that after solving the question and make a quick 3-step model on that. I would say at the first instance, what you need to do is just organize the fair value. Get the fair value of the original award, get the fair value of the replaced award. That's it. Just organize the data. Then you go to the step number 2, and in terms of the step number 2, you need to consider the proportion of the fair value of the original award on the date of acquisition. And then in step number 3, you need to get what is the portion which is to be accounted post-business combination. Because the pre-business combination portion will be accounted under Ind AS 103 as a part of the purchase consideration. And the post-business combination portion is going to be accounted as per Ind AS 102, which is share-based payments. Now let's go further. Let me now solve this part. Okay, so I think let's do one thing. Let's again organize the input. Let's first of all consider what is the fair value. And this is the fair value on the date of acquisition. You just need to organize the fair value on the date of acquisition for the original award. And you also need to organize the fair value of the replacement award. You also need to organize the fair value of the replacement award. So in the first step is just organizing the data for the step number 2 as well as for the step number 3. Now let's go back and see the data. So I'm very clearly given in the second para, it says the market-based measure of the original award is 1,80,000 and the replaced award is 2 lakh. So original award is 1,80,000 and the replaced award is 2 lakh. Then we go on to the step number 2. Now step number 2 would be involving the calculations of the pre-business combination. And the portion which is pre-business combination is going to be a part of the purchase consideration. That also reminds me, which I'm going to pen down in the mind map, that what kind of entries will you pass for this particular purpose. So we'll incorporate that in the mind map very soon. So we consider this is going to be the fair value of the original award. So we're going to consider the fair value of the original award. That is the base. And we're going to consider the proportion. We're going to consider the vesting period completed. We're going to consider the vesting period completed. In this case, as per the dates we've already seen, that out of 3, 2 years have already passed. And we're going to divide this by the total, or you can say the original vesting period, whichever is greater. So remember, you need to consider the vesting period whichever is greater. In this case, the acquirer did not change the vesting period. So original period 3 remains the total period 3. So let's take the fair value of the original award. This is 1,80,000. The vesting period completed is 2 and the original is supposed to be 3. So I think this comes to a total of 120. So this is going to be taken as a part of the purchase consideration. That is step number 2. Then we go on to the step number 3. Now in step number 3, you need to organize the portion which relates to the post-business combination. Now the portion which relates to the post-business combination is going to be, you can say, accounted. It is going to be accounted as per Ind AS 122. It is going to be accounted as per Ind AS 102. So let me, I think, still ask you a simple question, at least to be on a safe side. So when you're going to consider the accounting as per Ind AS 102, my quick question in this particular case is, when you're going to account this under Ind AS 102, in this particular case, is it going to be spread over the remainder vesting period? In this case, it is just 1 year. So let's say, for example, the vesting period would have been, remainder vesting period is, let's say, another 2 years. So are you going to spread it on a straight line basis and amortize it over the next 2 years? That is post business combination. Is the thought correct? The post business combination is going to be spread over the remainder vesting period on a straight line basis. Yes, of course. Yes, of course. Now let's consider what is the fair value of the replaced award. The fair value of the replaced award was to the extent of 2 lakh and minus the pre-business combination, that is 1.2. So this 80,000, this is what is going to be accounted using Ind AS 102. Well, that was another crucial aspect in terms of the purchase consideration. I get answers yes only when I say, should we make a mind map? So I think, let me put that question once again to you. You want me now to make a mind map number 3 based on the concept of a share-based payments? We can add some more elements of things as we make the mind map on the SBP. So what do you say? You want me to make a mind map on this? No, I'm going to get an answer yes on this. If no, I'm not going to make a mind map either. I get a yes on that. Let's make a mind map on that. Okay, so let's make now a mind map number 3. So this is going to be purely on SBP. This is my mind map number 3. And on this mind map number 3, I am considering this to be completely on share-based payments. Now, as I make the mind map on this, in the current question, what we did, our focus was typically on the mandatory replacement. But I think you would recall, what you have done in the detailed lectures as well, that when it comes to the accounting for SBP, there are basically 3 permutations and combinations. One is, we can say, is a case of mandatory replacement. And one is a case of, you can say, optional replacement. And the other one is a case where we can say that there is no replacement. So we need to consider 3 permutation combinations. One is on the mandatory, one is on the optional replacement, and one is when there is no replacement. Now, when it comes to a mandatory replacement, you need to apply a simple 3-step model as we did in the question. You need to organize the fair value on the date of acquisition, and we need to organize the fair value of the original award, and you need to organize the fair value of the replaced award. So we need to organize the fair value of the original award, and we need to organize the fair value of the replaced award as we did. Then in the second step, you need to consider the fair value of the original award, what you've already organized in the step number 1. And you need a proportion of this, and the proportion is based on the vesting period completed. We consider the vesting period completed upon, you can say, the total vesting period or the original vesting period, whichever is greater. So original, whatever will be there, and if the acquirer makes a changes in terms of the vesting period, you need to consider the total. So which is already passed by, and the additional vesting period. And then this is the pre-business combination portion. And this is going to be a part of the PC. This is going to be a part of the purchase consideration. And then you come to the step number 3, where you need to consider the post-business combination portion. And the post-business combination portion, you need to consider the fair value of the replaced awards. You need to consider the fair value of the replaced award, what you've already organized in the step number 1. And from this, you need to reduce the value as per step number 2. And this post-business combination, we've already said, is going to be accounted as per Ind AS 102, which is spread over the remainder vesting period. Okay, now another crucial input which I like to map in this mind map itself is, when you take this as a part of the PC. Now, November, once you incorporate this as a part of the PC, the extra entry which you need to pass is the PC gets a debit, and you need to give a credit to SBP reserve. This is, I think, the crucial entry which you need to do, because once you've taken this as a part of the purchase consideration, then you need to put an additional entry, and that is PC gets a debit and the SBP reserve gets a credit in this stage. Okay, this is on the combination 1, which is a mandatory replacement. Now comes the other one, if it is a case of optional replacement and if it is a case of no replacement. Well, if it is case of optional replacement, then there is nothing taken as a part of the PC. If it is optional replacement, it is accounted post-business combination only. It is accounted in the post-business combination only. So basically, you need to apply Ind AS 102 in this particular case. Nothing is to be taken as a part of the purchase consideration. Then comes the case where there is no replacement. If it is no replacement, then also you need to apply the 3 steps which you did for mandatory replacement. But in the second step, instead of taking it as a part of the purchase consideration, you tell me, where are you going to consider that? In step number 1, you'll organize the fair value, and you're going to organize the fair value only of the original award. There is no replace award. If there is no replace award, you just need to organize the fair value on the date of acquisition for the original award only. Then in step number 2, you need to consider what is the pre-business combination portion. By the way, I'm now going to get your answers from that. So where are you going to consider the pre-business combination portion? Of course, not about a PC. Where do you take that? Meantime, let me give you the calculations. We'll take the fair value on the date of acquisition of the original award. And we're going to consider a proportion, which is vesting period completed. Vesting period completed. And this is going to be divided by the original or the total vesting period, whichever is greater, because he may not do a replacement, but he may change the vesting period in any case. So I think I'll have to answer that. I did not get the answer. If there is no replacement, then it is a part of NCI. Then it is taken as a part of the NCI, because basically there is going to be no replacement. In that particular case, these awards will go to the outsiders, which is nothing but NCI. And then finally, in terms of the step number 3, the portion which is post-business combination, which will be accounted as per 102. So you consider the fair value of the original award, what you have organized in step number 1, and minus the value in terms of the step number 2, and this portion is going to be accounted as per Ind AS 102. Right, friends. So I think the mind map number three is also done. And I would say these are the three crucial aspects in terms of the calculation of the purchase consideration. You should be very focused, clear in terms of how the purchase consideration DC is simple, CCS is accounted, where the focus is completely in terms of deciding whether it is financial liability or equity. Then the focus is in terms of PHI. Then the focus is in terms of share-based payments. I would say these are the the most crucial elements in terms of PC. Right, so far so good on this. Now let's go further. I think I'm doing most of the talking in this particular case. Okay, now I think before we go further, I have taken now a question which is on reverse acquisition, but let me just, quickly connect some dots. Let me just, give you a little quick inputs in terms of the other parameters because we may not be doing questions maybe on the other steps like NCI or in terms of goodwill. So let's take a little quick mind map summary on the calculations of the goodwill as well as the NCI, then I think we're ready in terms of doing a full-fledged question with you. So let me now do some more mind mapping. Not exactly mind mapping, but just a little quick overview in terms of the other steps as well. Now, there are two, three things which are now coming in the back of my mind. As I said, step number one and step number two is not very crucial. I think acquisition dates are very clearly given in the question. And it's not very difficult to identify who is the accounting acquirer as well. But I think the challenge could be in terms of step three. So let's make a little quick recap in terms of the agendas in step three and a quick inputs in terms of the calculations of NCI and the goodwill, step 5 and 6. So we're just going to spend a few minutes in terms of just reviving our inputs in terms of step 3, in terms of step 5, and in terms of step 6. Then I think we're ready in terms of doing bigger, larger questions on the step. Let's begin. So I'm just mapping now the inputs in terms of step number 3. Now, in terms of the step number 3, I would say you have two sub-steps which you should do. Because it's all about organizing the list of the net assets. But I would say it is appropriate to divide this in terms of 3A as well as to divide this in terms of 3B. We divide the entire journey in terms of the step number 3, which is getting a list of net assets in terms of 3A and in terms of 3B. Now, in terms of step number 3A, what you need to crucial. So I think let me call this as mind map. After all, we're just doing the quick revision. So let me call this as the mind map number 4. And this is on step number 3, 5, 6. So in terms of the step number 3, I would say your focus point would be to see whether a tax rate is given in the question or not. So because if a tax rate is given in the question, then this will lead to the applications of Ind AS 12. This will lead to the calculations of the deferred tax calculations in this case. And let's quickly take a recap in terms of how do you apply the Ind AS 12. So not getting into details, but if it is not given, then it's not a problem. Then in that particular case, Ind AS 12 is not to be applied, then you're safe. Now, when you say that you're going to apply the concept of Ind AS 12, you need to be very clear in your thoughts that, okay, is it a taxable or is it a deductible temporary difference? And accordingly, you decide, is it a DDL or is it a DDA? So I think we'll just quickly pen down some thoughts. In terms of assets, if your carrying amount is more than the tax base, I think let me put some questions also to you. So what do you say? If the carrying amount is more than the tax base, does it become a taxable temporary difference? Or does that become a deductible temporary difference? If the carrying amount is more than the tax base of the asset. Then what kind of difference we call this? Excellent. It is going to be a taxable temporary difference in that case. And then this will lead to a deferred tax liability. And if it is the other way around, the carrying amount is less than tax base, then it becomes deductible in nature. So in this particular case, it becomes deductible temporary difference. And this is going to give rise to a DTA. And similarly, if it goes for a liability, you just need to be clear that this is going to be the other way around, exactly opposite as compared to the concept of assets, which means that if the carrying amount is more than the tax base for the liability, it becomes deductible difference in nature. And once it becomes deductible in nature, it would give rise to a DTA. And if it is the other way around, the carrying amount is less than the tax base, it becomes a taxable temporary difference, and that becomes a DTA. I think needless to make a mention in this particular case as well, that in this case, it is not the difference which is the deferred tax asset liability, it is the taxable temporary difference, which is going to be multiplied with a tax rate, and then you get the DTL or the DTA. So in terms of the step number 3A, you should first of all organize the deferred tax. Filter all those assets and liability where the carrying amounts and the tax base are different, and you can organize all that deferred tax. Then comes the step number 3B. Now, in terms of the step number 3B, what do you need to do? You just need to basically organize the list of net assets. So in this particular case, you just need to organize the list of the net assets. Now, when you organize the list of the net assets, you need to remember some crucial steps in this particular case. So I think I'll just quickly give you a mind map on that part as well. So when you're making the list of the net assets, I would say you just need to be careful on, single 3 parameters, I would say. Number 1, what you see in the balance sheet of the acquiring. What you see in the balance sheet of the acquiring is to be incorporated in the journal entry, that is acquisition entry at a fair value. That's the basic thumbnail. That all the assets and liability which are in the balance sheet of the acquiree, that's going to be incorporated in the acquisition entry, a part of the net assets at the fair value itself. Then you also need to see that there might be certain assets which are not in the balance sheet of the acquiree, but they still get captured at a fair value. And I would say typically, you would see contingent liability coming out here. You will also see intangible assets coming out here, because the intangible assets which are not in the balance sheet of the acquiree, because they're self-generated, but they will be a part of the acquisition entry. So when you're filtering all those assets and liabilities which are not in the balance sheet of the acquiree, but they're going to be a part of the acquisition entry, I think typically the contingent liability, typically the intangible assets will all come into play. Next, you would see that there could be certain assets which are in the balance sheet of the acquiree, but they will appear as it is. They don't appear at a fair value, but they're going to appear as it is. And I think one of the finest examples in this case would be the non-current assets held for sale. Because the non-current assets held for sale, as per Index 109, is recorded in the books at a fair value less the cost to sell. So we cannot afford to incorporate them in the acquisition entry at any other value other than the net fair value. So they will be incorporated as it is. Then there would also be certain assets and liability which are not in the balance sheet of the acquiree, but they will find place. But they will find place in the acquisition entry, which is other than fair value. And I think in this particular case, when you're looking at examples other than fair value, which are not in the balance sheet, I would say in this particular case, they could be something like, for example, indemnification assets. They would be indemnification assets. So I'm not giving you a complete list of assets liability. I think that you know from the detailed lectures which you have seen. But there are basically four elements which should go at the back of your mind. The four elements are what appears in the balance sheet of the equity is going to be a part of the list at a fair value, or could be a part of the list at the book value itself, or something which is not in the equity's balance sheet appears in the acquisition entry at fair value, contingent liability, intangible assets, or something which is not in the balance sheet and it appears other than the fair value, something like an indemnification assets. So this is the crucial points which you need to keep in mind when you're making the list of net assets, the different tax implications, and of course these few points as well. Then I think let's take a little quick recap in terms of the step number four. Sorry, step number five. Step number four, BC is already. Now there is nothing much crucial in terms of the step number five as well as in terms of the step number six. Now in terms of the step number five, you need to calculate a goodwill. Now, sorry, step number five, sorry, first of all, NCI. Step six will be good. So in step number five, you got to calculate the NCI. Now, there is nothing too technical about NCI, but when you're calculating the NCI, your focus point needs to be very clear that, okay, in this particular case, are you considering the NCI at a fair value, or are you considering the NCI at personal? If you're considering the NCI at a fair value, you should be able to relate it immediately that this fair value means that you're going to get a full goodwill. Because this full goodwill also has got implications in terms of impairment testing later. When we're going to come to consolidation standard, Index 110, we're also going to relate the aspect of that NCI being at fair value, the goodwill is full, and if there is impairment, how do you tackle that? I think that we'll see when we come to the aspect of consolidation. And if it is taken at Pasna, in this particular case, the goodwill is supposed to be called as a partial goodwill. This is called a partial goodwill. And if it is supposed to be a partial goodwill, then the impairment in terms of the goodwill is borne only by the parent company itself. That is another crucial point. But I think the concept of impairment we'll connect later. As of now, we're only concerned that your NCI could be at a fair value persona. And these instructions are very clearly given in the question. The data itself will be quite predictive, and you will be able to make an assessment that we need to consider this at what value. And then comes the input in terms of the step number 6, which is on the calculation of the goodwill. And when you're calculating a goodwill, I guess it's more like a mathematical exercise. The logics is all well understood in the detailed lectures. Now it's more like a computation. So what you need to filter in terms of the goodwill calculation is you need to take the purchase consideration, and it's all that data is very clearly given in the question itself. The PC you would have organized in step number 4. And then to this, you add the NCI. But remember, you don't need to add the NCI completely what you've calculated in terms of step number 5. You need to take the NCI on the date of acquisition. Of course, it will be taken from the step number 5, but it is only the NCI which is there on the acquisition date. And when you compare the sum total of this, you compare this with the net assets in totality. And this net assets is what you have organized in step number 3 already. So goodwill is all about just adding the PC and the NCI, comparing it with the net assets, and you get the goodwill. Now, once you get the goodwill, there could be some impairment inputs given. And one of the common mistakes people do in consolidation, which I'll remind you later as well, they'll land up reducing the impairment portion of the parent. Remember, in the goodwill calculations, you need to reduce the entire impairment loss, not just the parent's loss, but the entire impairment loss itself. Right, so I think that gives us a quick mind maps on all the things. I think leaving the step one and two, I think I'm more or less filtered and giving the inputs in terms of all the steps. We're done the discussions on step three, we're done the discussions on step four, we're done the discussions on step five and six, and then finally, it's all about putting the acquisition entry. Wow. So far, so good. I think we're now in a position to do a full-fledged questions with you at this stage. But I guess before that, I think it's time to give you a break as well. I'm sure you need one. So what do you want me to do after the break? You want me to do a question on acquisition accounting first, or do a question on a reverse acquisition? Though I think in the order of the assignment, what I've done, I've taken a question on reverse acquisition. So what do you want me to do? Acquisition accounting question, full-fledged one, or a reverse acquisition one? We'll go with your choice. I think since our seven-step models have been discussing everything on an acquisition accounting, that should make a little more sense. You can give me your inputs in the break on the chat box so far. I think we'll start back. Please enjoy a break. Acquisition accounting. Okay, that's wonderful indeed. So we'll take a break, friends, 10, 12 minutes. I'll be back. Haji. Welcome back, friends. I hope you had a relaxation of mind. So, I think as I was told, we'll do a question on acquisition accounting. So, I think I'm going to now start a question with you on acquisition accounting. So, let me share the question to you. Question 5 is on reverse acquisition. We'll come to that later. 6 is on a common control. We'll come to that later. Let's, I think, first have a look at the question number 7. Okay, so let's, I think, read the input. So first, we'll just go to the requirement of the question. I always tell people, that's a good idea that you first of all go through the requirement of the question so that you know exactly what is to be done. This question is there in the study material as well, and it's came in mock test papers in April 2019 as well. It says you're required to prepare an opening consolidated balance sheet of professional on 1st April X2, and we're also given a 10% discounting rate. Now, why do we need a discounting rate? We'll see that, of course. Let's, I think, now read the inputs in the question. Now, we're given the balance sheet of professional and dynamic on 31st March X2. We've already seen the question is asking us to make a balance sheet, opening balance sheet on 1st April X2. So let's now go to the additional information. It says in the other information, one, add 70% shares of Dynamic on 1st April X2 by issuing its own shares in the ratio of 1 share for every 2 shares of Dynamic. So we give the exchange ratio, 1 share for every 2 shares, and then it says fair value of the shares of professional is given at the rate of 40 per share. Something is working at the back of my mind, and that is because when you're going to do step number 1 or 2, you can change them interchangeably. You're going to identify the accounting acquired. And I think in that particular case, it is important that you know whether it is acquisition accounting or a reverse acquisition. So I am going to do some calculations later, and we're going to also identify that is it acquisition or reverse acquisition, because all depends upon who gets the control. Is Professional Limited still in control of his company, or by giving the shares to the shareholders of Dynamic, he loses the control that will decide whether it is acquisition or it is reverse acquisition accounting. Then it says the fair value exercise resulted in the following. Now we're given a fair value of the PPE, and then it also says that professional agreed to pay an additional payment as a consideration that is higher of 35 lakhs and 25% of any excess profits in the first year. A very quick question, friends, to you. It says it is agreed that they will pay an additional amount, which is the higher of the two, 35 lakhs or 25% of any excess profit. Now, when I read 35 lakhs, it gives me a fixed definite figure. But when I look at 25% of the excess profit, it gives me a feeling that it is supposed to be contingent upon the profits exceeding. By the way, is it a CC? Is it a DC? Or do you think it's a blend of CC as well as a DC? I think let's get that results from your side now. Is it CC? Is it DC or a combo? Think carefully, because there is going to be a payment which is greater of the two elements, 35 lakhs or 25% of the excess profit. If the 25% is more, the shareholder gets that more money. If 35 is more, he gets 35. So I'm just thinking, can I say he would get 35 lakhs irrespective? Because if you work out 35 lakhs and 25% of the excess profit, let's say 25% of the excess profit is 40 lakh, he's going to get 40 lakh. So you said a DC, or should I say it's a combination of DC and a CC both? Because if the 25% works out at 40 lakhs, you're going to pay him 40. That means you pay him 35 and that extra 5. So I would say it's a combination in terms of both the DC as well as the CC. And then it says this additional amount is due after 2 years. Dynamic has earned 10 lakh profit in excess. It says in the preceding year, and it expects to earn another 20 lakh. Now it has already earned 10 lakhs in the preceding year, and it is expecting to earn another 20 lakh. Now, if you take 25% of the excess, I think it's nowhere close to 35 lakhs, which means we're going to pay him basically 35 lakhs. So we can say, yes, effectively, it becomes a case of deferred consideration. Then he says, in addition to the above, professional also agreed to pay one of the founder shareholder 20 lakhs provided he stays in the company for the next 2 years after acquisition. This payment is going to be paid in the future, but it is going to be paid in the future provided he stays in the company for the next 2 years. So is this CCE or is this a CCS? So is this CCE or a CCS? Yes, it is going to be a CCE because there is a condition as far as a future employment is concerned. Since there is a condition of future employment, therefore, in this particular case, it becomes a CCE. Let's go further. Then it says Dynamic has issued certain equity settled share based payments with an original award which got replaced. It got replaced means it seems to be that it is a case of a mandatory replacement issued by Professional Limited. As per the original term, the vesting period is 4 years, and as on the acquisition date, the employees were already served 2 years of service. As per the replace awards, the vesting period is reduced to 1 year time. And then it says the fair value of the original award and the replacement award on the acquisition date is given, SVP. Then he says Dynamic has a lawsuit pending with a customer who made a claim of 50 lakhs. Management estimates the fair value of this liability is given. Now, a pending lawsuit would mean that it is supposed to be a contingent liability. And we given the fair value of this contingent liability. So certainly a part of the acquisition accounting entry. And we are given the tax rate is at the rate of 30%. The moment he gives you a tax rate, what comes to the mind immediately is that we need to apply the deferred tax consequences as well. Wow. So I would say it is a good question, but it's not very technical as well. So what I'm going to do now, I am going to use my Excel sheet and I'm going to solve that question on the Excel sheet so that at least you can see the handwriting also proper and you can see the steps also very proper indeed. So let's begin the journey and we're going to go step by step. Question number 7. I already have the Excel sheet with me. Let's begin. So I'm sharing the answer to you. Question number 7. I'm zooming it further so that you have no trouble in terms of looking at the Excel sheet. Just let me know if there is still any challenge to look at. Okay, so this is the question number 7. Sometimes people ask me a question as well that can I use these steps in the exams as well? Is it, good to write down working note 1, 2, 3, 4, or is it, that I write down step 1, 2, 3, 4? I think it's perfectly fine. If you ask me, I don't see that there is any trouble if you write down step numbers as well. But otherwise, you can say that your main answer is step 7. So you can maybe, number them as working note number 1 to 6. I mean, it's fairly fine. So my step number 1 is getting the date of acquisition. Though you can interchangeably use the step number 1 and 2 interchangeably. So we're going to go to the step number 1, getting just the date of acquisition. So let's come back and see what is the date of acquisition. I think it's very clearly given in the clause number A itself that Professional acquired 70% shares on 1st April X2. So I think my date of acquisition is 1st April 2000 x2. Then we come to the step number 2, and that is identifying. You can say the accounting acquirer. This is to me a very crucial step, because when you're looking at the step number 2, this is what is going to actually decide the fate, that whether it is going to be acquisition accounting or it is going to be a reverse acquisition. So this is going to be an important agenda. I think I've written the wrong spelling for acquirer. Yes. Now I think let's go to the accounting acquirer. Now I was making a small little mention which I'd like to take you back. Many times, people would read the question and says that professional acquired shares in Dynamic. So undoubtedly, professional is supposed to be the accounting acquirer. Well, I would say no. I think you need to make an assessment whether professional is an accounting acquirer or not. You need to do the calculations and find it out. So what I'm going to do, I'm going to calculate the pre and the post business combination status in terms of the number of shares of the company professional. Let's do one thing. Let's go back to the balance sheet. In the balance sheet, we're given first of all the balance sheet of professional. And if you notice in the balance sheet of professional, the share capital is appearing at 500 and the shares are 10 each. So we can say in this particular case, the number of shares in professional, I'm putting it as P, the number of shares in professional is supposed to be 50. 500 lakhs is the share capital. So the number of shares is 50. Now, I also want to find out the number of shares acquired by P in Dynamic, that is D. So I want to calculate the number of shares acquired in this particular case. So when I look at the number of shares acquired by P in D, in this particular case now, if I go and look at the data in terms of clause A, he's acquired 70% shares, and then it says that he will issue 1 share for every 2 shares. Now, if you just go back to the balance sheet in terms of Dynamic, the total share capital is 400 and the share is 100 each. And that means it comes to a total of 4. So we can say the number of shares is 4 and we acquired 70% of the shares. Now 70% in this case would mean 2.8. So we can say this is the number of shares acquired by P in D. But I also want to find out the number of shares. I want to find out the number of shares issued to the shareholders of D. So what I've done, first of all, I did the calculation of the shares in Dynamic. And we said we acquired 70% of the shares as per the instruction in the question. And then it says that we are going to issue 2 shares for every 3 shares held. I think it's 2 for 3. No, 1 is to 2. So we're given that we are going to issue, 1 share for every 2 shares held. So that means against 2.8, we will issue 1 share for every 2 share. That comes to a total of 1.4 shares. Now, why I am doing this calculation? Because once the company professional issues shares to the shareholders of Dynamic, you can say he would have diluted his holding. You can say that his percentage would have gone down. So I think if I try to calculate what is the percentage held. Now let's say he has got a total of, the shareholders of professional have got 50 shares. The total share capital becomes 51.4. So I'm trying to now calculate that out of a total of 50 shares, the total shares now in the company is 51.4. So we can say that he's got 50 divided by 51.4. It comes to 97% approximately. This calculation actually proves me that professional is still in control of his company. I know sometimes these calculations you may not see extensively given in the solutions, but I think to my mind it's an important calculation, because if this percentage would have gone down below 51%, in this case we would have said the control of professional is gone. Then we would have said the control is basically passed on to Dynamic. So in this particular case, once we know that after professional issued the shares to Dynamic, we can say he is still in control of the company. So this gives me the conclusion that if I want to identify who is the accounting acquirer, I would say the accounting acquirer is supposed to be P, that is professional. I hope, friends, you got my calculations clear, because most of the time you may not see these calculations being done. But I hope I'm very clear on my thoughts that I took the number of shares in P and I identified how many shares P issued to the shareholders of D. What is the total capital base of P post the business combination? Because I wanted to identify that once the shares are issued by P to D, it leads to a dilution of holding. And once it leads to a dilution of holding, still he is in control of that company. And since it is in control of the company, he becomes the accounting and the legal acquirer. Right, friends? I hope so far so good. You got my calculations clear? Because to me, I think this is a very, very crucial calculations indeed, because this is the deciding fate. Is it acquisition accounting or is it supposed to be something else? I didn't get a yes on that. I hope, friends, you got my calculations clear. Yes or no? Okay, so I presume that to be yes. Thanks for the input. Now, let's go further. We go to the next step now, the step number 3A. Now, the step number 3A, as I said earlier, is going to be computation of deferred tax. So I would say the next is the computation of deferred tax. So we are given a tax rate in the question, and we now need to go in for the calculations of deferred tax based on that data. So what we're going to do now, we're just going to identify all those assets and liabilities which are taken at other than the book value. So we need to see the book value, and basically the fair value will become the book value and the tax base will be the book value itself. So let's go back. Let's first make a chart. Let's take a column for particulars and let's take a column for the book value. And let's take a column for a tax base, and we can get the temporary difference. Consider a tax rate, and based on the tax rate, we can calculate the deferred tax. So this way we can organize the data in a well-fashioned working notes as well. So I think now before we fit in the data, let's go back to the question and see which items there is a difference. Now, if you notice, we are given in the point number B, it says fair value of the PPE is given to be 350. Now, this fair value indirectly becomes the book value, because as per the acquisition entry, you are going to capture the PPE in the books of accounts at 350. So let me record this PPE. So we can say the PPE is got a fair value, which is a book value 350. But when you record this fair value, in any case, the income tax authorities are not going to give you a future deduction based on the fair value. The tax base, as per Indus 12, represents the, you can say, future deduction. And the future deduction will be limited to the extent of the book value of the asset. So in the balance sheet, we're given a figure of 500. So we take the tax base to be the book value, which is 500. In this particular case, we can clearly see that the book value is supposed to be lesser than the tax base. So this difference of 150 is what we can say is supposed to be deductible temporary difference. I'm putting this DDT. The tax is at the rate of 30%. So when you multiply this 150 with a 30% tax rate, this comes to a total of 45. This is going to result in what? A DTA. This is going to result in a DTA, though we know that when you create a DTA, it is subject to, you can say, the concept of prudence. And I think in the absence, I'm fairly simply assuming that yes, the fair value might be met in this particular case. Okay, I can go further. The next input is in the additional information. So PPE is done. Then I guess further, if you go to the additional information, I think nothing more in point number B. Then I guess I am given the inputs in terms of point number E. Now, in terms of the point number E, I am given that there is a lawsuit against the company, and that is got a fair value to the extent of 5 lakh. So this will also be a part of my inputs. So we can take this as a contingent liability. Now the book value is the fair value 5, but in terms of the tax base, you will get a deduction at a future date. Once the payment is made, the future deduction will be made. So the tax base is the carrying amount minus the future deduction. So you can say carrying amount is 5 minus the future deduction is 5. You can say this becomes nil. Now, in this particular case, again, the book value is more than the tax base. If the book value is more than the tax base, then this difference can be classified as a taxable temporary difference. I'll put it as TDD, taxable temporary difference, which is to the extent of 5. And again, we apply a tax rate. Again, we apply a tax rate which is 30%. That I think comes to 1.5, and this is going to be DTL. So I think we should be able to now get the net figures. 45 minus 1.5, we can say the net figure works out at 43.5. That is supposed to be the net deferred tax asset which needs to be created. Okay, let me just also keep the question in front of me as we progress. Just a second, so that we are not lost anywhere in the track. Yes, so I think my calculations of the DTA is done. So this is, I would call it as a net DTA. So this is my step number 3A, where we have organized the calculations of the deferred tax, all those assets and liabilities which are taken at a fair value. So the fair value becomes the book value, and indirectly the book value becomes the tax base, with the help of which we are able to get the deferred tax implications. Okay, now let's go to the next step. That is step number 3B. As you go step by step, your focus remains very clear. You're able to relate the data very well. So this is now going to be a list of net assets. So we're going to make a list of net assets at a fair value. So let me put it at fair value. So let's take the net assets at the fair value, step number 3B. So now what we'll do, we'll make a scrutiny of the balance sheet, and we go item by item, pick up all the assets. Where the fair value is given, we'll take that. And where the fair value is not given, we'll just take the book values itself. So let's go back to the balance sheet of Dynamic. Let's start with the asset side. So PPE, we've already seen, has got a fair value of 350. So let's take this as 350. Next item in the balance sheet is investments. I don't think so. We're given any information about investments. So that appears at 100. So that investment appears to the extent of 100. Let's go to the next item in the balance sheet. Then there is inventories, remains at 150. Nothing is given. So we take inventories, and that is 150. Then next item is the financial assets comprising trade receivables. That's 300. So we take the trade receivables, that works out at 300. Then next item is the cash and cash equivalents. That is 100. So we take the cash and cash equivalents. I'm putting as CCE. That's 100. And the next I am given others, that is 230. So we take the other items, that is 230. And we also need to consider a DTA, which is taken 43.5 in the previous step. Let's also merge that up as well. I think the asset side is all done. There is a contingent liability which we need to consider, which we'll take later. Let's now come to the balance sheet on the liability side. So we're given the long-term borrowings is 200. So let me first do one thing. Let's take the sum total of this. So this comes to a total of 1273.5. Now let's go to the liabilities. So we're given long-term borrowings. So let's take the long-term borrowings in this case. The long-term borrowings is given 200, and then there is long-term provisions, that is 700. Long-term provisions, LTP. So this is to the extent of 70. And then we also have the DTL, which is given the deferred tax liability. The deferred tax liability is to the extent of 35. So we fit this 35. And the next item is the short-term borrowings, that is 150. So we take STB, short-term borrowings, that's 150. And the next item is given to us, it is trades payable, that is 300. So we take the trades payable, that is 300. And I think that's it. And then further, least we forget, there was a contingent liability as well. I think the contingent liability was to the extent of 5. So we can take the sum total of this as well. That will give me the liabilities. So now we can comfortably take the net assets, and that would be assets minus liability. So since we're doing it in the Excel, I'll take advantage of that. So I think it comes to a total of 513.5. That becomes the net assets of the company. Great. So I think this gives me the status. Sorry, this is 513.5, right? This is 760, and this is, I guess, is the total correct or not? DTA, was I think 43.5 only. I guess, did I make some calculation error on this? I think I made a little error. Nobody stopped me as well. On the liability as well, it's a deductible temporary difference. Nobody vouched me for that. It leads to a DTA. So this is going to be 46.5. I committed an error in terms of the contingent liability. So let me just change this 46.5. Now you can see the advantage of the Excel. Automatically my calculation gets fine. Right, so step number 3B is done. The list of the net assets is taken care. Now comes the crucial step, which is on the calculation of the purchase consideration. So let's go to the step number 4, which is on the calculation of purchase consideration. Now, as you calculate the purchase consideration, I would say, you should get into the habit of organizing the 7 issues in a go. Because if the question is comprehensive, you can always organize the data so that we are very clear in our thoughts. So what I'm going to do, first of all, I already know the PC in the form of shares at fair value, which we had already calculated. I think we landed up issuing 2.4 shares, I think. Let me just go back. I think we landed up issuing 1.4. So we landed up issuing a total of 1.4 shares. That's right. And we also have the fair value. So we landed up issuing a total of 1.4 shares. And let's see what is the fair value of the shares. So we're given in this particular case, the fair value of the shares of professional is at the rate of 40 per share. So 1.4 shares issued at 40, I think that works out at 56. Now what I'm going to do in this particular case, I'll just pen down all the 7 issues. As we come across, we can just keep fitting those 7 issues as well. So the first issue what we confront is DC. And I think there is a DC. Let me first, I think, make a list. Then there is CCS, then there is CCE, then there is TC, then there is SBP, then there is PHI, and then there is pre-existing relationship. Then there is pre-existing relationship. So we can just take the inputs from here. So I think let's first with the I've given the DC calculations in the point number B2. Now, in terms of the point number B2, we were given that professional agreed to pay an additional consideration that is the greater of 35 lakhs and 25 lakh, 25% of any excess profit. Now, we can very clearly see that it earned 10 lakhs in the last year and it is expecting to earn 20 lakhs in the next year. So the excess profit is only 10 lakh. So if you pay 25% of the excess, it comes to 2.5. So we'll end up paying 35 lakh. So that is indirectly the DC and it's going to be paid 2 years later. And the discounting rate is given at the rate of 10%. So we can take the discounting 35 lakhs is going to be discounted at the rate of 10%. So take the factor 1 divided by 1.1. Second year factor, I think is 0.826. And we will be able to get the present value. So this is 35 into 0.826. That comes to 28.91. That comes to 28.91. So this is the deferred consideration. Then let's see if there is anything else which is given. SBP is there, but I think there is also point number C. Professional agreed to pay one of the founder shareholders 20 lakhs provided he stays in the company, that is CCE. And we know CCE is not taken as a part of BC. So there is no CCS. CCE is not taken. TC is not there, taking it as 0. Now we need the share-based payments. So let's go to the share-based payments, which is in point number D. It says Dynamic has certain equity settled share-based payment award, which got replaced by new awards by professional. As per the original term, the period is 4 years, and on the acquisition date, they've already served 2 years. So out of 4 years, 2 years they've already served, and another 2 years is yet to be served. But he says, as per the replaced awards, the vesting period stands reduced to just 1 year. So can I say the original period is 4, the total vesting period is 3, so we need to take whichever is greater. So we'll take the fair value of the original award, that is 5. So we take the fair value of the original award 5 into vesting period completed is 2 and the original vesting period is 4. So we need to consider 2.5 as a part of the PC. And I think there is no PHI. I think there is no pre-existing relationship as well. And I think that's it. So now we can comfortably take the sum total of this. We get the purchase consideration. See, if you're focused and you're making a calculations on a step-by-step basis, the chances are you're not going to go wrong in this particular case. So that gives us the purchase consideration, that is 87.41. So that takes care of the step number 4, that is the calculation of the purchase consideration. Now let's go further. Now we need to go for the step number 5, and the step number 5 is calculating the NCI, that is on the date of acquisition. And I think we just need to be careful that is the NCI being taken on the fair value or is it taken at Pasna? Right now, that also does not make much difference at this stage, because when you're considering the calculation of the NCI, we're doing everything on the date of acquisition. So whether it's at full value, partial, that is going to get impacted only when the goodwill impairment comes. So let's go back on the agenda. Let's see if there is any information on the NCI. I don't think so. He's made any references to the fair value calculations of the NCI. So I guess the NCI is going to be taken comfortably at Pasna. So we will take the NCI at proportionate share in the net assets of the company. So for this purpose, you already have the net assets in the step number 3B, 516.5. So we can take 516.5 into 30% because 70% of this is acquired by the parent company. So we can say 30% becomes the NCI, 516.5 into 30%, that is 154.95. That works out at 154.95. Great. So even the NCI is done, and now we go on to the next one. So we will consider the E point in the contingent consideration. Well, in terms of the contingent consideration, E point. No, 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 that's not contingent consideration. E point is supposed to be the amount of contingent liability that we've already considered in step number 3B when we made the list of net assets. There is a difference between a contingent consideration and a contingent liability. The contingent consideration is a part of the PC calculation. And in this particular case, since we landed up paying 35 lakhs, so technically there was no contingent consideration payable. And contingent liability is already taken in the step number list of net assets, that 5 lakhs. I hope you're clear on the issue, right? Okay. Okay, so with this calculations in hand now, let's go to the next step. That is step number 6. The step number 6 is now on the calculation of goodwill, which is nothing, but is just simply organizing the data. Just pick up the information and just fit it across. So once it comes to the goodwill, you need to take the PC, and to this you need to add the NCI on date of acquisition, and then you reduce the net assets, what you have already computed in the previous steps on the date of acquisition. So I think let's first go to the purchase consideration. The PC is 87.41. That is the PC. The NCI is 154.95. And let's take the net assets. The net assets we have taken is 516.5. I'm putting into the brackets. So I think now we can comfortably get the amount of goodwill as well. So PC plus NCI less the net assets. This is coming minus. Minus means it is a capital reserve. So this is supposed to be a capital reserve. That is 274 point decimals. Okay. I think now everything is well organized. Now we can just simply put the acquisition entry as well. But the question is not asking you an acquisition entry, but I'm still going to put the acquisition entry. The question is asking me to make an opening balance sheet, which also I will do. So let me first go to the step number 7. And then step number 7 is going to be putting an acquisition entry that is on the date of acquisition. So we need the step number 7 acquisition entry on the acquisition date. So in this particular case, I think I'm not putting a detailed journal entry. I think I'm just going to put the entry in a condensed manner. Like for example, the net assets, the breakup is already there with you. So I'm just going to put the entry net assets gets a debit. And you can take the purchase consideration gets a credit. You're getting NCI that gets a credit. And we've already got a capital reserve that gets a credit. So it's all about organizing the information, which you can basically copy the data from the goodwill calculations itself. So your net assets is supposed to be 516.5. Your PC is supposed to be 87.41. Your NCI is supposed to be 154.95. And the capital reserve is supposed to be 274.14. Right. So in any case, the entry will tally because we've just taken all the data from there. Now, I think let me put a small little inputs to you. You can vouch me on that. I'm just thinking aloud, just vouch me, is my thoughts right or not? He's asking me to make an opening balance sheet in the question. So I'm just going to give you an input, vouch me. Can I just simply take the balance sheet of professional from the question and just incorporate this acquisition entry? Am I going to get the consolidated balance sheet, which is on 1st April X2? What do you say? Take the balance sheet of professional given in the question, just incorporate that acquisition entry within it, and you get the results. That is the opening consolidated balance sheet. What do you say? Is my thought process correct? Just think about this. I'm just going to take the balance sheet given in the question and incorporate the acquisition entry within that balance sheet. Is the resultant balance sheet the consolidated balance sheet? Is my thought correct? No vouching. Well, of course, that's right. Exactly. That's what we're going to do. So what I'm going to do now, I'm just going to make a balance sheet for the ease of convenience as well. The question is asking us to make an opening consolidated balance sheet, which is on 1st April 2000 X2. So let's do one thing. Let's just pick up the balance sheet and just keep incorporating the data. So let's make the balance sheet as well, because the main requirement of the question is making this. In fact, as I said, for the earlier steps, you want to call them as working note numbers. That's, pretty fine. Doesn't make a difference. So let's, I think, pick up the information from the existing balance sheet. On the NCA, we've got PPE and investments, non-current assets. We've got PPE, we've got investments. By the way, there is no goodwill, otherwise we would have taken the goodwill as well. So I think there is nothing more coming on the non-current asset side. Then I guess on the current assets, we've got inventories, then trade receivables. So we've got the current assets, we've got inventories, and then we've got financial assets. And within the financial assets, we're given the elements in terms of trade receivables, cash and cash equivalents. So we take the trade receivables, we take the cash and cash equivalents, and we're also given others as well. So we put this others. And let me, I think, now take the liability side as well. So this will give me the total assets. Let's go to the equity and liability side as well. So we've got equity, and within the equity, we need to show the bifurcation as well. That is equity share capital. And apart from the equity share capital, we are also given the other equity. So we'll also show the other equity as well. And then further, after these, we are given the non-current liabilities. Remember, we also need to consider the deferred consideration as well. So let's take the non-current liabilities, in which we've got the long-term borrowings, and we are given the long-term provisions as well. And I think least I forget, let's take the deferred consideration as well. That would be non-current, because it's going to be payable in the next 2 years. And then deferred tax, we'll take net. So we'll take the deferred tax liability as well. And then we consider the current liabilities. And in the current liabilities, we've got short-term borrowings and trades payable. So STB, short-term borrowings, and there is trade payables. Let me just quickly highlight the main headings in the balance sheet as well. So current and non-current liabilities, that's it. Okay. Now I think we're in a comfortable position to pick up the data. So I think in order to show the workings, what I'm going to do, I am just going to consider the column. This is the balance sheet of P, and this is the data from the acquisition entry. And on that basis, you can get the total figures out here. So we just now pick up the information, keep incorporating the entry. So we just keep the balance sheet on one side, and we're just going to consider the acquisition entry on the other side. So PPE is to the extent of 300. And I think this was the fair value, that is 350. So let's take the sum total of this. So we get the sum total of this. So this works out at a total of 650. Then I guess we go to the investments, that's 400. In the acquisition entry, that's 100. So this works out as the total investments out here. Then I guess in the current assets, we've got inventories. And I guess the inventories are 250. And this is, I guess, coming to acquisition entry was, I think, 150. So we get the sum total of this, just incorporating the acquisition entry as it is. Then we got the trade receivables is 450, and that is 300. So we take the sum total of this, that works out at 750. Then we've got the cash and cash equivalents is 200, and that's 100. So we take the sum total. This is also done. Then I guess on the others, we are given 400 and it is 230. So this is 400 and this is 230. So we take the sum total of this. And that's, I guess, on the asset side. I think my asset side is taken care. The DTA, we'll take it net in terms of details. So I'm not taking this separately. We're indirectly assuming it's going to be set off. So this works out at 3230. That's on the asset side. Now let's go to the liability side as well. We'll consider the equity share capital. So I guess the equity share capital in the balance sheet is appearing to the extent of 500. Then I think as a part of the PC, we had issued some portion. So I guess if I look at what was the consideration issued, we had issued a total of 1.4 shares, which is got a face value to the extent of 10. So I think the face value will become 14. So least we forget, we need to add a share premium, because we can say that out of the total 56, because we had calculated a total of, I think, 1.4 shares at the rate of 40, that was 56. So you can say 14 becomes the face value and the remaining 42 is going to become a share premium. So I think we'll take care of that later. So let's add this up. So that works out at 514. Then in terms of the other equity, it is appearing to the extent of 810. And I guess what we need to consider out here is now two things very carefully. Let me, I think, pinpoint that as well. One is I'm considering share premium. And I think the other item is the SBP reserve. The other item is supposed to be the SBP reserve in this case, because you took the mandatory replacement of the share-based payment awards in terms of SBP. So that SBP reserve needs to be segregated here as well. So security premium is going to be 42. And I guess the SBP reserve was, I guess if I go back to the PC, the SBP reserve was 2.5. So we need to remember to consider that SBP reserve as a part of the other equity. In fact, you can even take, separate line items for all these things, but I've just merged everything as a part of the other equity. That gives me the sum total of the other equity in the balance sheet plus the premium and the SBP reserve. Now let's go to the long-term borrowings. So long-term borrowings is 250 and it is 200. So this is 250 and this is, I guess, 200. So we'll get the long-term borrowings as well. And then we go for the long-term provisions, 50 as well as 70. So this is 50 and 70. This gives me a total of 120. And then there is a deferred consideration. Let's pick the deferred consideration as well. My deferred consideration was to the extent of 28.91. So this is a part of my acquisition entry. So let's put this as 28.91. Payable in another 2 years. So we've already taken that as non-current in nature. So this comes to 28.91. Now for the deferred tax, we need to be slightly a little careful. Okay, I think I'll perhaps take it directly itself. This was 28.91. So this also is 28.91. Now, as far as the deferred tax liability is concerned, the DTL is to the extent of 40, and we have incorporated a DTL of 35, and there is a DTA 43.5. So I'm reducing that because I'm taking a net DTL. So less the DTA balance, that comes to the net figure. Similarly, we take the short-term borrowings. It is 100 and 150. So this comes to 100 and this comes to 150. So this works out a total of 250. And finally, we've got a trades payable that is 250 and 300. That's 250 and that's 300. So we get the sum total of this. And I think now hopefully the balance sheet should get agreed on this particular case. Let me take the sum total of this. So this total works out here, and that is to the extent of 2770. I think, did we miss out any portion in this? I think something which I missed in this entry, I think. But anyway, I think the concept is correct. I think I missed out some calculation here and there in terms of things, because basically the balance sheet which is given in the question, we just need to incorporate the acquisition entry in that case. So anything which I missed out in the acquisition entry, I guess. Capital reserve. I think I missed out on the capital reserve as well. So in the equity, we're also going to consider the capital reserve as well. That was, I think, 274.14. 274.14. So I think there is still some difference which is pending, I guess. Let's see, minus 274. So there is some slight difference. Anybody able to locate where I missed out the inputs? Because practically, once you're making this opening balance sheet, you just need to consider the balance sheet in the question and just add the figures which are there in the acquisition entry. The total of the balance sheet should be 3230, that is for sure. Let me just see if there is any error out here. My equity share capital is right. My other equity is correct. I think, yes, I missed out on the NCI. Yes, I think I missed out on the NCI as well. NCI was to the extent of 274.14. So NCI works out at 274.14. Yes, I think now the balance sheet is agreed. Slight difference due to decimal calculations. But otherwise, I think the balance sheet is agreed. Slight difference of around 1 point something. Well, so this makes us the opening balance sheet as well. So as I said, the main crucial point is picking up the balance sheet from the question and incorporating the acquisition entry in this case. Right, friends. So I think this takes care of the question as far as the acquisition accounting is concerned. Now our next agenda is in terms of reverse acquisition, as well as the concept of common control, and then 103 will get over, and then after that we'll start with 110. But I guess that seems to be all good. We don't have too much more time to go except 5 minutes. So over to you, friends. Any questions on your side? Any question, friends, on your side?
Good morning, sir. Sir,
Good morning,
in
ma'am.
case students are not having any question, then let me pose a question for them.
Sure.
Kushi, since you are there, I would like you to please fill that feedback form, and also I hope you are there in the WhatsApp. Hope you are in that WhatsApp group. Kushi, you can unmute yourself and tell, or you can just give me your reply over the chat box. Okay, so maybe that she is not able to unmute herself. Still, students, those who are watching this live virtual revisionary classes, I would request everybody to please fill the feedback form, show your expectations so that we can provide and cater that and resolve your queries in case you have any. And be continuous for these revisionary classes, because continuity is what is important. It is not that you have to possess that high level of intelligence for this course. It is that your sincere and continuous work, hard work is required to succeed in this exam. So all the best, students. So over to you. You can carry on.
Thank you,
And
ma'am.
okay, sir. Bye, sir.
Yes, any questions on your mind? Otherwise, I think that's all from my side today, unless you've got any questions to ask. Right, friends. So I think that's all. Then we're going to see you on Friday. We're going to continue this trail. See you on Friday, friends. Thank you very much. Bye bye and take care. Thank you.